Hey, good afternoon, guys. This one's a subscribers only stream, right? So, again, a couple of questions in the technical question section, a couple of other kind of DMs that I've had. And I just want to kind of put a few pieces together. I think there was one also in the crypto section, right, which was, this year, right? So, to start with, the question that I had in terms of Aussie dollar, right, and I guess kind of looking at whether or not it's corrective, looking at whether or not it's an impulsive move to the downside, and so on and so on. Part of the reason that I talk about only entering a four or a two, and it's not a golden rule, right? Now, what I'm going to do, I'm going to kind of again answer these two questions kind of at the same time, right? So, if you imagine a price that does something like this, right? And let's just assume that this is it. I'm not going to do any fibs or anything else on this, right? When the prices come down and travel down for some time, you're going to have some kind of an accumulation, right? So what you really want to see is as the move breaks above, right, you start to get this kind of acceleration. Now, the reason that you get the acceleration is that technically internal to the schematic, you've actually had these moves kind of sideways. And inside that, you've had an impulsive one, pull back two, and the acceleration comes from the break there, right? So, although this is just squiggly lines at the moment, right? This is, again, kind of me trying to answer three questions kind of rolled into one, right? The reason that I don't like trading corrective, and the reason for this in general, especially when you look at Elliott waves, right, is in Elliott terms, the golden rules are pretty simple, right? You can't have number two to number three be in the shortest, right? So if I was to draw this like this and draw this like this, right, the chances are this is the shortest. This breaches one of the golden rules, right? Now, there's nothing stopping us having something like this, back like this, then ultimately having something like this, then a massive four correction followed by quite an extensive five, right? It's less likely, it's less often, right? But in the grand scheme of things, it doesn't break any rules because three was not the shortest, right? So it's as simple as that, right? Now, the second rule is four here can't dip below this level there, right? So if four was to come down A, B, C, breach this level, we invalidate it, right? These are all impulsive moves, right? This is where the three rules come in very useful, right? The third rule is two can't go lower than zero, right? That there, the same as four down to one. This can't break that level there, right? If you break that, it kind of invalidates the count. Right? So they're the three golden rules. Now the reason that I wanted to bring this up again, right, is when I look at a corrective move, right, regardless of how I've drawn this, come back down for this, bring in for something like this, more realistic, right? Now, the reality is, when I look at a corrective move, you've got zigzags, flats, triangles, you've got extensions, you've got double three and triple three combos, you've got the potential for a 618, a 100%, a 123%, a 161.8% type retracement. You've got six different types of triangles or diagonals, right? Now, the issue is, in the grand scheme of things, is it's just too much. It's just too much going on compared to, do I see an accumulation at a level that I like? Right? Well, level tick in the box. And this isn't Bitcoin, this isn't Aussie dollar. I'm just saying this is the logic, right? You start seeing the sideways action. You start seeing the bigger time frames. Maybe the stochastic is already down low. You've got a stochastic, it looks something like this, right? Now all of a sudden, you see a change in character. That change in character is the first real clue, right? You come back and you get some confirmation. Now, at this particular stage, the move down looks tired. It looks corrective after an impulsive move, right? That there is the optimal type of entry, The only issue being is that when you're trading this on a weekly time frame, this could obviously take months to farm itself out. Now, the chances are you drop down to a daily or a 12 hour and you start to see these things more and more and more. If you're not looking for too many trades, and in the general sense, the obvious place and the best place for collecting bigger moves on a, I suppose, on a smaller time frame, right, is if you were to look at this, what you've actually got is you've seen this, you've seen this, and you've seen this. You see this move getting tired, and you see a floor. Okay. Now, obviously, at this particular stage, the benefit that you have there is you've got all of this information. We accumulated at a key level. We've seen an impulsive break of structure. We've seen a retest of that level. We've actually accelerated as we break the one. We've come through. We've got an extension of the 1618 of the 3. We can see a clear ABC. This is different than the 2. All of these things add in kind of favoritism to your bias, right? This is, this is the beauty of the kind of waiting for the confirmation, right? Now, obviously, at this particular stage, the reason I'm putting all these together is you look at this from a confirmation perspective. I'm not looking to jump in, right? I'd rather sit on my hands and sit on my hands and sit on my hands, because when this trade comes, if I was to look at this trade and say, okay, I can see this extension, I'm going to get a swing out of the impulsive move, I'm going to get a pullback 2. I can enter on this 2, even if I come in at 618, I come in at 86, my stop loss is going to be very, very, very tight, right? Now, obviously, you could drop your stop loss down there because you know you're wrong, right? But there's nothing stopping you bringing it tight, right? Now, you can actually target the 2618 extension, right? When you start now on this impulsive journey, as we start going up 1, come back 2, when we break that nested 1, you've got an entry again. But this time, you can go in deeper, but you've still got the same targets, right? Then you start getting past that, you get into the 3, you come back 4, you end up with another you end up with another opportunity there, right, on that 4, giving you a similar kind of target, similar kind of, you end up with a 30-40% trade that you can almost guarantee. Right? And I'm not saying this happens all the time, obviously this is a bigger time frame. But now what you can do is you can take this down to the smaller time frame and apply the same technique, okay? So this is part of, you know, the conversation I had with a DM about Aussie dollar, right? The reason that I like this compared to a corrective is corrective could be this, it could be that, it could be the other, it might be something else. It might be a triple three, it might be a double three, it might be a zigzag, it might be a flat, it might be a bigger zigzag and we've got a flat inside. These are all the issues that you're just guessing, right? So what I like to do is I like to see this. Now, the next part of the question, right, is if you now think of something like a fair value gap, right? And this fair value gap, what I've just done is just come into ChatGPT, basically just asked for, to define this with a little bit of sense, right? So what causes a fair value gap in the stock market question, right? This is a type of thing you can do, pretty straightforward, right? Now, in terms of market sentiment, right, this is where these things combine, right? This is where, for me, these things combine. Market sentiment, right? So let's take Bitcoin as an example, and we talk, bullish, we talk Bitcoin quite a lot. You've got things like earning reports. Let's replace this with the halving or net inflows, right? You've got obviously all these microeconomic factors, what's going on in the world right now. And I know this is the stock market, right? But the general sense, right, is in theory, in an impulsive market, right, you're going to see as the price comes up, comes back, when we break this level, you're going to start to see the fair value gap there, right? Because at this stage, we've collected stops short. We've actually got new breakout orders long. We've got orders down here long, right? We've got lots of reason to create, an acceleration, right, in the price, which then ultimately leaves a fair value gap. Now, if you then think of what a fair value gap does, we've now created this little box after we break above this level. The chances are 4 is going to come down to this. But we know from the Elliott wave rules, it's unlikely to break this. Right? So the chances are it's going to come down 50%, etc., etc. we're going to know that that's going to be a deep retracement. You know, we might end up with another gap in H3, 4, which means 4 could end up coming here. Right? And this is where the logic then starts to kind of piece together, right? Now, everything I've just talked about there on the Elliott wave, impulsive, 3 golden rules, blah, 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 right? What you've then gone and done is you've actually created this little move, which technically has left outside liquidity. Okay. Now, if we assume bigger picture, what we've gone and done is we've come down ABC. We potentially have gone up. Let's just assume that this is the 1. We could come back for a 2, which could be really deep. You know, see what I'm doing here? We're going to break up and accelerate 3, 4, 5. Yeah. So at this particular stage, what we've now done, right, is we've created this move inside. We've kind of gone back and collected, you know, fair value gaps. You might see this being already taken within the 4. Then this one is taken there within the next move down. As we then accelerate and we go 1, 2, 3, 4, you know, 5 again, right? What we've then gone and done at this particular point is we've done exactly the same thing on a larger scale. Right? We've potentially left gaps in and around this region. We've picked up the gaps in and around that region. We've come and created new areas. This could be, you know, master patterns, for example, because now we're talking bigger time frame. And it doesn't necessarily mean bigger time frame for the master patterns, right? But this is how these things are fractal and how they overlap. Right? Now, what we've then gone and done is we've got a bigger cycle, 1, 2, 3, 4, 5, right? And I haven't put the 5, you know, all the way up, right? Just to kind of keep it all on the screen. What happens then? We come back down with potentially a much larger A, collecting all of this central piece, coming back and retesting the underside, and then coming over to take outside liquidity, right? So just because we've got outside liquidity there where we are right now from this conversation, right, it doesn't necessarily mean we have to collect it immediately. It just means it's there for the future. It's an area of interest for that future, right? So when I'm putting, like I said, all of these pieces together, right, if I look back at this and I look at this drawing that I've just stuck on the chart there, right, what I've gone and done is if I've created my nested, you know, 1, 2, and this is just kind of brief, 3, 4, 5. Right? This, in theory, has created a potential 1 move, right? For example, we could have then created inside this, we could have had an A, B, and a C, right? Which could give us a 2. Now, these are the kinds of scenarios you've got to be thinking to yourself, well, okay, let me look a bit deeper inside of this move. I know what I've done here. I've gone and missed this one, gone and missed this one. I've come back down, which means inside this move, I've now got a nested 1, 2, 3, 4, 5. Okay, so that potentially takes me only up to a 3. And these are, you know, these are where you go back. And obviously, Elliott is going to be very subjective, bigger picture, right? But once you start to fit these in, you can say, well, actually, I don't like that where we are, which is part of the reason I keep saying nothing's changed, potentially an A followed by a B followed by a C, right? Now, if I put all this on the chart and I start looking at these particular levels, you know, the logic and the rationale behind this is when we come down for the swing, this move here is clearly where the area of interest was there. So what you're actually doing is you're creating an area of confluence, right? And the price is wanting to come back to at some stage, right? Now, when we've gone the opposite way, right? Let's assume that this is bullish or bearish, it doesn't really matter, right? What we've then gone and done is if we assume to start with a bullish move, you're going to have to go potentially 1, 2, right? Now, that's probably too weak for a 3, right? So if we just said, you know, whatever we've got in there, let's count this as a 1. We come back for a 2 because we can count a 1, 2, 3, 4, 5 in there. We come back for an A, a B, and a C, right? We can then come up. We're going to have to extend this, come back 4, up 5, right? 4 doesn't breach 1. right? So all these things are pretty good. I can look at the fib extensions and say, let's go 1, 2, 1, 2. We actually come not quite the 1618, right? But it's close enough in Elliott terms. Again, not really a golden rule. But what we have now done is we've crossed the 2618, right? Which is the optimal kind of finish for a move. So even if we say this is a bullish move, right? We then got to look at, what are the options? Where do we kind of hyperextend to? Where do we fall to? And all of these, pieces that we've just added there, where have we created the gaps? And where have we created the master patterns, the consolidations, etc. We get rid of all of this a second, right? So the reason that I wanted to put this video together and kind of put all the pieces together, right, is when you look at jumping in to a trade, you're not analyzing it in the depth that I've just gone through. And this is like, I don't even know how long this video is already. This video is actually, 16 minutes, right? And I've talked about 3 different questions. So it doesn't take 16 minutes to go through one particular chart. It's not going to take 16 minutes. You can kind of do this. And once you've got a monthly view, weekly, daily, they become, seconds rather than minutes. When you start then looking at the corrective moves, the reason that I don't like them is they're messy, they're ugly, and they're subjective. When I start looking at fair value gaps, what am I creating at the end? I'm creating accelerations, right, in the move. So if I come back to finish this video off and I say, well, look, actually, we've accelerated there as we technically broke above that high, right? So let's assume that, okay, that's bullish. Right? Let's just say this gives me a 1, 2, 3, 4, 5 count, right? As we break above this level there, right, we don't really get bullish there, right? So we don't get bullish until this particular stage. Now we've created another gap. Now what we've then gone and done, so if I turn this indicator on, we've now got where the liquidity sits, right? But what you can see in terms of the gap is the lack of volume. So the chances are when the price breaks down and below these levels or up and above these levels, right? We've created a gap. When the price breaks down below, there's nothing really supporting that until we come all the way back down here, right? So this really is where you can start looking at, 1, what causes the liquidity, 2, where the liquidity sits, and 3, using the Elliott bias to put all of these pieces together. Because once you start mapping out your 1, 2, 3, 4, 5, you'll start to understand where the ABC is likely to come back to and for what exact reason, right? So when I look at the 69K high back in 2021, I'd said one thing on my post, right? We were up and around this level, and I said, we're going to see 40 odd K. Well, actually, it was earlier than that, it was around this level. And I was talking about the 3, 4, 5 move, why we would get the truncation. Well, liquidity, right? There's the obvious liquidity. And why we would see 40K again very quick. There's the liquidity, right? So at this particular point, the actual outside liquidity is this one. So we technically grabbed outside to now come and go all the way back outside. So at this particular stage, we've gone outside to outside. What we're now looking for is outside to inside. And then you're going to go inside to outside. So the reality is what you're very likely to see now is a move down, move back up, and a move back down, right? But not taking outside liquidity. And the reason you don't take outside liquidity there is that if this then becomes the 1 and this becomes technically the 2, right? Because you're going to have the potential truncated move to the inverse on the 2 because you're not actually going lower in that sense. What you've then created is either one of 2 things, a 1, 2 move nested, right? Which means this is a 1 internal, this is a 2 internal. And then when you break up above this the next time, you'll actually see the acceleration up and above, right? Or you've got a 1 followed by the 2, which means you're going to see the A into the first pocket of liquidity, fill in the gaps, back up and testing the underside, and back down grabbing all of the liquidity before seeking outside. Then you're going to create new outside because you go in inside, outside, inside, outside, based on, inside, sorry, outside, inside, outside, inside, outside, right? And therefore, what you're likely to see is as you create that momentum, you'll create the fair value gaps. You'll start forming the consolidation zones, which become the master patterns, which technically you wake off situations, schematics, etc., etc. Right. So hopefully this helps, answer all three questions kind of at the same time. And for me, just to summarize, the reason I don't like that impulsive move is you're guessing. The reason that the fair value gaps are created are based on the acceleration on new orders, stop losses, et cetera, et cetera. They create ultimately low levels of liquidity, which are then easier to fall through. There's no real support or resistance at those levels, depending on which way they come from. Then ultimately back into what I was saying about outside liquidity in this question, from Max 21. um, Ultimately, you don't have to go outside to outside. You got to look at what the bigger picture is saying, and it's kind of outside to outside technically before it becomes outside to inside, and then inside back to outside, creating that impulsive move. And it's just the market cycle. All right. So anyway, hope you enjoyed this one. Thanks for watching, guys, and I'll see you on the next stream.